Hey, good morning, options traders, and happy Friday once again, everyone. Well, what are parameter Greeks? This is a good topic when you start diving a little deeper into your Greeks, the sensitivities of our options based on a pricing model. So what are the parameter Greeks and why are they important? Well, let's do a little background first of the Greeks. And I do have other videos in this forum talking about Greeks if this is a new concept to you. But the basic Greeks are delta, gamma, theta, vega, and rho. And these are really just sensitivities to different factors within a pricing model. They tell you how sensitive your options price is going to be if the stock changes, or how sensitive your delta is going to be, and things like that. They are just outputs from a pricing model. But within this group, we can also separate them into different camps. And of these five, vega and rho actually fall into a little different category called a parameter Greek. So again, that's what we're trying to figure out in this video. Why are these parameter Greeks? What makes them a little different from delta, gamma, and theta? Well, to understand, take a look at our pricing model. If we go into a pricing model, we have to give it the stock price, the exercise price, the risk-free interest rate, volatility. Now also keep in mind that volatility is not necessarily what the current volatility is. It's what we expect it to be in the future. So that's the volatility input, and then of course we need to know time to expiration. So within these five inputs that you have to give the model, it will give you these various outputs, or the Greeks. So the ones that are highly associated with the stock price are delta and gamma. Delta shows you how sensitive your options price is to changes in the stock's price, while gamma shows you how sensitive your delta is. But they're both tied to the stock price. And of course, the stock price is going to be highly variable, unless you want to assume that it's going to stay exactly dead flat between the day you buy the option and expiration, which is never going to be the case. All right, so the stock price is really the thing that we consider to be variable in the model. Now, what about the exercise price? Why don't we have any Greeks associated with that? Well, the exercise price simply doesn't change. Once you buy or sell that option, that stays the same. So because the exercise price never changes, there's no sensitivities to it. So that doesn't have any associated Greeks. Risk-free interest rate, the Greek there is rho. And for volatility, it is vega. And of course, the time to expiration, the associated Greek is theta. So recall in the previous screen, I showed that rho and vega are the two parameter Greeks. So what makes these different from the others? Well, again, the main idea is that, yes, these are all inputs to a pricing model, but the risk-free interest rate and volatility are assumed to be fairly constant, especially for short-term options. Yes, they do change, but they're more parameters of a model. We have to give the model the risk-free rate and the volatility in order for it to give us an options price. But the options pricing model is saying, okay, for a given interest rate and volatility, what's the options price and how are these outputs going to change? What is the delta? What is gamma? What is theta? Those are really more outputs. Now you might think, okay, the risk-free interest rate might leave it blank, but that's essentially giving it a 0% interest rate. Volatility. Do you want to give it the current volatility, the future volatility, forecast volatility? That's fine, but it's fairly constant. The options pricing model is only as good as the risk-free interest rate and the volatility that you give it. Once it has those, it can now go to work and say, okay, I can tell you the options price, I can tell you delta, gamma, and theta. See, what makes these parameters is that they're more fixed. That's just the way that we look at something in a model or in math. The parameters are things that are relatively fixed. The stock price is highly variable. Exercise price, again, is fixed, but there's no Greeks associated with it. Time to expiration, of course, is variable, but as I've talked about in previous videos, that's not really a risk. It's 100% known. We know the moment we buy that option, how much is going to decay between now and expiration. And that's just the extrinsic value. It's 100% known with 100% accuracy. So you have to ask yourself, is that really a risk? So all of the inner workings of the Black-Scholes model are trying to figure out the options price and these outputs, delta, gamma, and theta. But it can only do so if you give it an accurate interest rate and volatility. So the point of this is to understand that, especially for rho, normally we don't really consider rho. We just say, oh, options aren't that sensitive to rho, so I'm just going to ignore it. And we also know that vega does have a very big importance, but it's not all that variable. So we want to put these two Greeks, rho and vega, into a little separate category, which are called parameter Greeks. So what's the importance of this? Well, remember that vega and rho are your parameter Greeks, and they are assumed to be relatively constant. The stock price is variable, highly variable, as we all know. Time is variable, but again is exactly known. But vega and rho are perhaps more important for risk management than delta and gamma. Why? Delta and gamma are precise, assuming you have interest and volatility correct. See, we don't work it backwards. We don't say that interest rates and volatility are correct, assuming you have delta and gamma correct, or assuming you have the stock price correct. Stock price is just a starting point. It's assumed to be highly variable. But the volatility and interest rates are a parameter of the model. It needs those in order to calculate the option prices and those sensitivities. So the main thing to understand is that, especially for all of you who totally ignore rho and think that it has no point, is that they are important. And they're probably more important for risk management because all of your decisions are based on things like delta and gamma and theta, but those are only as good as the volatility and interest rate assumptions that you give the model. So it's just another couple of points to think about, that when you're out there using these pricing models that look highly precise, they'll go out to 4 decimals, and it's math, and everybody says, oh, therefore I know for a fact. No, you don't. They are only as good as the assumptions that you put in. So always keep that in mind whenever you are making decisions, because if you're making decisions based on bad assumptions, you're going to get bad outcomes. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.